but I want to throw this out because you're talking about the way things have changed. One question that I have, and I think this might be a question that every taxpayer in Illinois has, is this. When Jim Edgar left office in January 1999, the state of Illinois had a surplus of more than $1 billion. And this was at a time when the state had just come out of a recession, not by any means along the scale of what we've seen in the last few years, but still coming out of a recession, and at an income tax rate of 3%. What has changed in Illinois that even with a 5% income tax rate, we can't come close to paying our bills? And I know you mentioned debt has a lot to do with it.
Well, two things, and reporting. So that $1 billion surplus was a bit of a myth, right? According to the comptroller's office, we've been running deficits in Illinois for 26 consecutive years. So they may have had some cash on hand, but they were running a deficit. And the reason that deficit has grown has been the intentional borrowing passed by the Edgar administration and supported by the General Assembly against what was owed to the pension system. So in 1995, our unfunded liability across all 5 public pension systems was $17 billion, which was double what it was in 1989, $8.7 billion. So the state borrowed that heavily. It doubled its unfunded liability in just 5 years. Now, it did that to mask over this structural imbalance I talked about between revenue growth and service cost growth. So in 1995, they told the public that they were going to handle that problem by passing this, what we commonly call the pension ramp law, which requires the state to pay back what it borrowed against the pensions over time in accordance with the set schedule. The schedules run out 50 years to the year 2045 from 1945. And if they made 1995, and if they made all the payments, then in 2045 the systems would be 90% funded.
Right.
But what they didn't tell the public is they've imposed this now new payment burden for debt on the state, and they didn't pass a nickel of revenue to fund it. And they still had that imbalance between revenue growth and service cost growth that encouraged the state to borrow against the pensions and create that debt in the first place. So who thought that would work? And the answer is no one. So by design, that pension plan borrowed significantly over the next 15 years so that it grew the unfunded liability from $17 billion to over $46 billion in the year 2008. And in the year 2008, we were in the middle of the Great Recession, markets crashed, we lost the value of a lot of assets. Then we started changing some assumptions for our pension systems. These public workers keep living longer than we want them to. So at the end of the day, overnight, our unfunded liability ballooned from 48 to 95 billion. But it was all because we continued to borrow to paper over a structural imbalance. We never, ever fixed tax policy to fund services or to tax people fairly.
Okay, Ted, and I bet you've got a very different interpretation of how we could end up with $1 billion surplus under a 3% flat tax versus $7 billion in unpaid bills today under a 5% tax. What's gone? How does Illinois get back to that? What went wrong?
So, again, Ralph is right. There's a lot of math behind what we do. And of course, it depends, I guess, how you add your numbers. We just add differently than Ralph. Ralph's premise, interestingly enough, is that we have a borrowing problem and that we just need more revenues. And that premise we find false if you look at the math. Illinois has a spending problem. It spends, it spends, it spends. It doesn't know how to stop. And since it doesn't know how to stop, it borrows. And when it's borrowed as much as it can, it goes to the taxes, which was the 2011 taxes. Does anybody know how much of the tax increase in 2011, that $7 billion increase that was supposed to, by the promises of Governor Quinn and the leadership, they promised to pay down our bills and it would turn around Illinois' economy? Does anybody know what percentage of that tax increase went to pensions? 80%.
I do.
80%. Yeah. And this is the problem with our spending problem in Illinois. If you give, with all due respect to the politicians, if you give Springfield the money, they will spend it. And what they won't do is they won't reform. And the whole premise and the problem that we have with the progressive tax proposal is that Illinois needs massive reforms. We are 45th in the last decade in GDP growth. We are the number two, I apologize. We're the number 2 in growth rate in food stamps. We, of course, have the worst credit rating. We have the worst funded pensions. What we need are reforms that get our spending back in line with what other states are doing. If we turn around and raise taxes again on people, Ralph is forgetting that people can vote with their feet. A lot of people in Illinois are frustrated. They will vote with their feet. And in the end, it can be counterproductive to raise more taxes. So what we need to do is do the reforms on pensions. We need to not give Springfield more money, but have them balance their budget just like all of us do at home.
And Ted, this brings up another point. The proponents of a progressive system, as Ralph expressed, really bill this, and I think if these bills come up for votes, it will be sold as a fair tax, a more fair way of taxation. But why? Now, I know that Illinois Policy Institute, for those who don't know, ultimately you'd like to see Illinois join those 7 states with no income tax.
9 states, yes.
And, or 9 states. And, but what, assuming that Illinois is going to have an income tax for the foreseeable future, why is a flat rate tax on everyone better than a progressive system?
Sure. The way I look at this is if Ralph and I are both earning money, we both pay the same, today we both pay the same flat tax rate, 5%. So if Ralph, for some reason, is very successful, comes up with a new idea, a new product, and ends up making 10 times more than I do, well, with a flat tax, he will pay 10 times more in taxes than I will. And if he's really successful with his idea, let's just say he makes 100 times more than I do in income, he will pay 100 times more in taxes than I. And I would argue that's pretty fair. Now, under Ralph's proposal, he's saying it should be maybe 200 times or 300 times. And then the question is, where does it end? And doesn't it become unfair to tax people's success at a higher rate than somebody else? And that's the problem. We think that taxing success and taxing it at higher and higher rates is not fair. It actually punishes success. And let's use, I'm going to give you 2 examples of how it punishes success. Think about the entrepreneur who's been struggling in his or her basement trying to make that product for 3-4 years, just barely getting by. And finally they start to have success. Well, you know what? For all that struggle, a progressive tax system will tax them more and more and more. And it punishes their success. And it actually may take away the needed funds that they need to reinvest in their company and make it grow and create more jobs and create a more vibrant Illinois. That's example number 1. The second example are 2 teachers. 2 teachers well in their careers. Let's assume they're both making $70,000 each, 75. If they're married, they will pay more taxes under the CTBA plan than they would under a 5% flat tax. So it's not longer a tax for the rich. It becomes unfair, and it actually taxes the middle class and more.
Okay, and I should add too.
Can I respond to a couple
sure.
of things there?
And I want to add that, like I said earlier, right now there is no bill in the General Assembly that says here's what our tax structure is going to be. The CTBA, in the information packet that you have, we've got a column from Ralph where he lays out one possible scenario. So I was going to turn it over to you, Ralph, and ask, your whole your report states that taxes actually will go down for a whole lot of people under a progressive system.
Yeah, so we ran a model through the Illinois Department of Revenue's dynamic modeling system using the actual returns of taxpayers in the current tax rate. We excluded the first $5,000 of income, which is not currently done in Illinois, and then we created a rate structure trying to cut taxes for most people. And what we ended up with was a rate structure that reduced the income tax liability for 94% of the state, over 9 out of 10 taxpayers, people earning up to the $150,000 a year he just cited, and then raised taxes on the people earning over that. But effectively, the tax rate at the very top only increased by about anywhere from 1.1 to 2% of effective tax burden, so a very marginal increase. And as for the example he threw out there, it's the kind of stuff that we don't do at CTBA, but since he brought it up, I'm going to have to deal with it. We look at how tax policy impacts the entire class. We run it through dynamic modeling systems to take into account things like tax evasion. We have it peer reviewed. One of our peer reviewers, for example, is the head PhD economist at the GAO in Washington, D.C. on state and local tax. When they took our example and tried to show that it cost these two teachers more, they had a married couple file jointly with no children and lose $5,000 of their exemption. Well, it ended up with them paying more in taxes. But if they filed singly, they'd end up paying less. My guess is they'd be rational and file singly and pay less. You can sort of cherry pick and create any kind of fictional taxpayer you want to come up with whatever results you want. What we try to do is look at the entire class and run the numbers rationally. That's number one. Number two, he raises the point that people will run screaming out of Illinois if somehow, some way we raise taxes at the top of the income ladder. There is no peer-reviewed study that reaches that conclusion. In fact, a recent meta-analysis of all the research on this done by the Center on Budget and Policy Priorities in Washington, D.C., showed that there is no correlation between a state's tax policy and individual movement. In fact, California has a net problem with immigration of millionaires. Millionaires are moving to California. Under Ted's logic, it's to be taxed at higher rates because California has one of the highest income tax rate structures in the nation. And as far as economic growth goes, let's talk about that a little bit. What we saw when we looked at the data, and this is just hard, cold data, is that there's absolutely no correlation between a state's tax policy on the income tax and economic growth over time. From 2000 to 2010, the Institute on Tax and Economic Policy in Washington, D.C. reviewed the economic growth of the 9 states in America that have the absolute highest marginal income tax rates versus the 9 states in America with no income tax at all. So this isn't the highest marginal tax states versus the lowest marginal tax states. It's highest taxing states versus no income tax states. They looked at 3 core economic indicators: change in GDP per capita, change in median wage, and unemployment rates. And over that 10-year sequence, these high marginal tax states had better growth in GDP per capita, they had better change in median wage, and they had identical unemployment rates. That doesn't mean one taxes oneself to prosperity. We don't make that case. But it disproves the canard that, in fact, simply having a progressive tax structure or even one that has higher rates than other states somehow puts you at an economic disadvantage to other states. Recall that while Illinois is doing poor economically right now, we did poor the 30 years prior when we were one of the lowest taxing states in economic growth. There are other factors that matter significantly more. And in fact, the single factor that had a statistically significant correlation between positive economic growth on a competitive basis, meaning a state grew its GDP at a faster rate than its share of the nation's GDP and other states around it. The only correlation was between those states that invested the most in K-12 education and enhanced that investment over time versus those states that didn't. Why? Because, and the data tell us this, from 1980 to 2012, the only cohort of workers in America that saw their incomes increase after inflation had a college degree. Every other worker saw their income declining. You need high-end numeracy and literacy skills that are so good that you go on and credential yourself at the next level to be a viable worker in a modern economy and qualified for a good job. Illinois has disinvested in its K-12 education system, and after you factor in per capita spending as a percentage of state income, we rank in the bottom 10 or 12 states consistently in our K-12 funding. I tell you, it's abysmal, and it needs resolved.